Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Welcome back to the show, Rick.
Well, thanks for inviting me on, Jim.
You used to talk to us from Colorado. Now you're on the Jersey Shore. How's that sea breeze?
Today, not much of a beach day. You know, as I moved east, I left Colorado, and I'm on my way to Florida post Labor Day, but I'm just spending some time with some of my best friends here on the Jersey Shore where I grew up. And the murderous heat that we've had across the eastern part of the country, I guess everything east of the Rockies has finally broken. So we've had a couple of days of pleasant weather, even if it hasn't been too sunny.
The U.S. equity markets look like they want to set new record highs almost every day. What's your read on it?
It scares the hell out of me. You know, this market hit long ago decoupled from reality, but I think it's particularly egregious now because the auto sector and housing have very clearly rolled down. You know, the auto sector in particular is going up against an 18 million plus a year, and we're not going to get anywhere near that. And of course, just the mild skew in interest rates has affected the leasing market. The leasing market is a little bit like the mortgage market, in that the whole purpose of leases is to allow patriotic Americans to drive much more car than they can afford. So, you know, both businesses, housing and autos, are very sensitive to interest rates, and I think we've seen an actual peak. I'm a little more sensitive to home prices than the average consumer, because I do have my house listed for sale in the really hot market in Boulder, and I can tell you that the realtors came into the selling season this spring really fired up, mainly because they were reading all the cock and bull headlines about, you know, economic recovery and the Fed's fear that the economy was going to overheat and all that shucking and jiving. But so the realtors were looking for maybe the best season ever. But where the rubber meets the road, namely where home buyers actually pay to buy homes, they were definitely not geared to pay bubble prices. So we've had kind of a rude awakening in the real estate market, especially in Boulder where I lived, and I think I'm almost sure that real estate is topped, and you know, there'll be some regional differences, but even in the Bay Area, we're starting to see a little bit of softening in prices, not only of home prices, but of rentals. So you know, it's to me, when you're topping out in the housing market and the car sector, it's only a matter of time before the market catches on.
With those very important segments of the economy under pressure, why is it we see our central banks ignoring that? They really don't seem to factor real estate in very much at all. They still look at widget sales.
Well, I've never really pinned it down as to whether our Federal Reserve is run by imbeciles or liars or some combination of both. But that pretty much covers who they are and what they do. And, you know, they're still sticking to the hoax that the economy is strong enough to stand on its own, even as we're sinking into recession. I think we'll be in statistical recession within 2017. So this really doesn't fit the Fed's plan. The Fed's plan is just to con everybody into thinking that the economy is strong enough that it can withstand a couple of tightenings, but of course it cannot. And so we've had just a couple of 25 basis point token tightenings. The idea being that if you get administered rates back up above 2-3%, that you'll have some room to move in the next recession to ease. But strictly speaking, they should be easing now rather than trying to bluff everybody about more tightening this year. Just one more turn of the screw could bring the entire house of cards down, and I mean globally, not just in the U.S.
Is that how sensitive everything is? It just takes just one little feather to land on the back of the camel or the donkey or the human, and you break everybody's back.
Well, the reason for that is, you're talking about a shell game that aggregates to something like $2 quadrillion plus. That's one with a whole bunch of zeros. But, even though the whole world only produces, I don't know, let's use a figure of global GDP of 70 or 80 trillion dollars. Well, we've got this financial juggernaut with financial instruments aggregating to something like $2 quadrillion, maybe a little bit more. That takes in all the derivatives markets and everything else. So the question is, why does a world that transacts only $80 trillion worth of real goods and services need a financial system that's working with at least 3 more zeros? But the problem there is that entire amount is subject to the pressures of that turn of the screw. So if you ratchet interest rates just a little bit higher, you're impacting not just real global GDP, but this financial shell game that is hugely larger.
We'll have more with Rick Ackerman right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're chatting with Rick Ackerman. Rick, do you feel sometimes the central bankers feel they have to do something, or they can't say that they're doing anything to help out, so they always feel they have to meddle in some way?
Yeah, I think that's been their chartered mandate since 1913 or so, and they're always going to feel like they have to do something. And the whole idea that the central bank can fine-tune the economy, of course, has been refuted by generations, decades of periods where the economy was in a wallow, and most clearly now, when everything is kind of pumped to the sky, and we've got Wall Street going nuts, where at a time when the real economy, and just talk to anybody who's got a business to verify this, but the real economy is not going great guns. Anybody with a business is out there paddling upstream, paddling as hard as he can just to make some headway. So the business climate is tough, very competitive. That's especially true in the retail sector, where we've had creative destruction aplenty in brick and mortar retail. You just take any business, a low margin business like groceries. We've got Amazon as the 800-pound gorilla. Walmart as the 800-pound gorilla. Something like, I think it's more than 40% of Walmart's revenues come from their grocery store. But now, Amazon jumps in as though there were plenty of money, lots of business to go around. So, and it's the same thing in all the fast food outlets and retailers. It's so competitive now that the margins have come down, and this is in no way reflected in the stock market. The stock market is just a creature of it's smacking its lips over all this creative destruction without having adjusted to the lag that's going to take place between when this destruction is occurring, namely now, and when there's an economic payoff somewhere down the road. And let me also mention that that economic payoff has come within the lifetimes of people who witnessed the creative destruction itself. But I think we're in a very different environment right now, so that the benefits of all these great strides and efficiency we've made with technology are not going to translate into more wealth for everybody for a few generations. So this is a lot more creative destruction than we've had in the past. And again, with the stock market at record highs, it seems to love the fact that that there's going to be just 3 companies in business there making any money in another 10 years.
What 3 companies will he be?
Well, certainly Amazon and maybe Facebook. And you have to remember, though, that and Google and Microsoft, of course, will be at version 15 of Windows by then. The last 12 versions having been more or less gratuitous. But we'll have just a few players, and you have to realize that a couple of those really big players are just glorified advertising agencies, Facebook and Google. So it's only been a relatively recent development, meaning in within a generation, that companies that were just advertising firms have become vastly larger than the vendors that they supposedly serve. So tail is definitely wagging the dog, and we've got so much money so much capital really going into just BS, a company like Uber. I don't doubt that Uber has a good idea, maybe even a great one, but there's a question as to whether it's worth a $68 billion valuation.
Well, it seems to me that they lose, $2-3 billion every year.
Yeah, and the old joke about, but they make it up. They make up for it with volume. So when Uber will become profitable is an open question, but I don't think it's an open question as to what it has, in the David Ricardo, in the classical economic sense, what it has creatively destroyed. It's made taxi medallions worthless in many large cities, and there's no real gain in net worth except for the private equity shareholders of Uber, because all the taxi drivers who you put out of work, they come to work for Uber, but I don't see where the wealth is produced with Uber. In a purely looking at it again from a classical economic standpoint, you would take the capital that had been malinvested in less efficient taxi services like your yellow cab fleet in New York, and that capital would eventually find itself into more productive outlets. But we don't have those yet. A lot of money is scrambling to go into healthcare, namely because healthcare is a government business, and you always want to be where the government is willy-nilly throwing money, taxpayers' money. So, but it's like all these things in the economy are being gutted and disemboweled before the next big thing comes along.
We'll have more with Rick Ackerman right after this.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Rick Ackerman. Rick, what's your outlook on gold right now?
Well, it's at a very critical place on the chart. When I look at the weekly chart and I go back to the 2011 high on COMEX gold futures, it was somewhere around 1900. We're trading, closer to, we're in the 1200s now. And if you connect up a few dots there, namely some peaks that occurred along the way from that high to where we are, we've come right up against a trend line almost to the dollar today. And to me, it feels like a do-or-die time on the charts. If we don't pop above the election night high, which is a real resistance point for gold, and do it soon, I think gold could sink. And if you take that upper trend line and you draw a parallel line off a bottom that occurred, a key bottom in 2013, you wind up with a long-term chart, like a weekly chart, that shows gold with the potential. I'm not forecasting this yet, and I have trouble believing it, but you can come up with a technical case for $400 gold. So there are only a couple people out, as far as gold bugs are concerned, the lunatic fringe, talking about $400 gold. But let me just say that it's not very far-fetched looking at this weekly chart and the channel that you can draw. That's pretty reasonable. So I think we need a pop here, and if we get it, it will be simultaneous with the pop in bonds, and the dollar is going to turn around. You know, we're going to have gold rising, but at a time when the dollar is strengthening. So obviously, when we're talking about such a tectonic shift, big markets, the bond market, the market for the dollar, not so big gold, but still gold would be a part of the move. It's either going to happen or it's not, but it can only happen in such a way, you know, all the money managers wake up one morning and think all together, geez, what have we done? We are so up to our eyeballs in stocks, we need to jump into something else. So one of the reasons I keep recommending long-term bonds, besides the fact that they've been in an uptrend for 36 years, is that there's going to be a massive unwind. All the foolishness that has gone into crazy, stupid, completely wrong ideas, like the dollar should be weak, the euro should be strong, bonds should be weak because we're going to have some sort of economic resurgence. All of that, I would say the whole world has it wrong. And so if you get on the opposite side of the trade, there'll come a day, really, when a day of reckoning, when the unwind sends your investment, and it's well out the yield curve, into the ionosphere.
Do you think we might have another Black Friday like we had August 25th 2 years ago?
Well, Friday seems a little bit obvious, you know. I think it's going to be more like a Black Tuesday at 3 a.m. in New York. You know, we'll wake up some morning and something horrific will have occurred in European and Asian markets, and there won't be much you can do about it if you're invested in U.S. markets. So Friday does seem a little obvious, but I don't know. I'm just so, this market really spooks me here. It's just so crazy, and you know, any given day it's up, and even the corrections in key stocks like Amazon, it feels like the market is capable of correcting no more than 2 or 3 hours at a time. It just wants to go up for no good reason.
Rick, thank you so much for chatting with us.
Well, it's always a pleasure, Jim.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website, rickackerman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.